The AI market just changed its rules overnight, and the investors who do not understand what happened this week are going to get destroyed. Welcome back to AI Assets. Today, we are breaking down the most important shift in AI investing in 2026, a change so fundamental that it reframes how you should evaluate every single AI stock in your portfolio. And it happened in plain sight, in the middle of a single week, in 3 separate earnings reports that told the exact same story. Let us get into it. Here is what happened this week. Cerebras Systems reported 92% revenue growth, beat every single analyst estimate, announced a $20 billion OpenAI partnership, and the stock fell 11% in aftermarket trading. Read that again. 92% revenue growth. Stock down 11%. That is not how markets are supposed to work, and it is the most important signal in AI investing right now. For 3 years, the rule of AI investing was simple. Show growth, get rewarded. Revenue growth, user growth, model capability growth, any growth was enough to drive valuations higher. The market was pricing the future, not the present. Every AI company was a story stock, and the story was always the same. AI is the future, and we are winning. That rule just died. What Cerebras showed is that the market has shifted from pricing growth to pricing margin quality. Cerebras grows at 92%, but its gross margins are significantly below Nvidia and AMD. And in the new AI investing regime, thin margins on high revenue is not a growth story. It is a warning sign. The question is no longer, are you growing? The question is now, how much of that growth can you keep? Now let us connect this to the broader market picture, because Cerebras is not alone. SpaceX debuted as one of the most anticipated IPOs in years. Within 12 days of its listing, the stock had already fallen 16% from its peak. Not because SpaceX's business deteriorated, but because the market repriced the gap between narrative value and demonstrable current margin. And Micron, up 298% year-to-date heading into its Q3 report today, faces the same test. Analysts expect 932% earnings growth. If guidance disappoints even slightly, the stock will fall hard. Not because Micron is a bad business, but because a 298% move in a single year has priced in perfection, and the new market regime has zero tolerance for anything less. This is the new pattern. Extraordinary numbers are no longer enough. The market wants extraordinary numbers and extraordinary margins and extraordinary guidance. Miss any one of the 3, and the sell-off is brutal and immediate. Now, the investor context. Here is exactly why this matters for your portfolio right now. The old AI investing playbook was built on one assumption, that AI companies in hypergrowth mode deserved premium multiples because future margins would justify current valuations. The market was willing to look past current profitability and price the end state. That assumption is being unwound in real time. What is driving this shift? 3 factors converging simultaneously. First, interest rates. The ECB just raised rates again in June. Fed rate cut expectations have been pushed further into 2026. When rates are high, the discount rate applied to future earnings rises, which mechanically compresses the present value of growth stocks. High multiple AI companies are disproportionately exposed to this dynamic. Second, CapEx reality check. Microsoft, Google, and Amazon have collectively committed over $300 billion in AI infrastructure spending in 2026 alone. Investors are now asking the logical follow-up question: when does that spending convert to earnings? The answer, not for several years, is starting to make some institutional investors nervous. Third, supply of AI stocks. The total volume of AI-related share issuances in the first half of 2026 has hit dot-com-era levels. When supply of AI equity increases faster than investor demand, valuations compress even when underlying businesses are performing. Here is what the market is missing, and this is the critical insight. The companies most exposed to this regime change are not the obvious ones. Everyone is worried about the AI startups with no revenue. That is not where the real risk is. The real risk is in the AI infrastructure companies that have revenue, but whose revenue depends on CapEx from the hyperscalers. When Microsoft or Amazon decides to pause or slow their AI build-out, the ripple effect hits every company in the supply chain. The server manufacturers, the cooling systems, the networking companies, the inference platforms. And the companies least exposed to this regime change? The ones with direct, recurring, enterprise subscription revenue that does not depend on a single customer's CapEx decision. Microsoft itself, paradoxically, is in a strong position here. Its AI revenue comes from enterprise subscriptions to Copilot and Azure OpenAI services. That revenue is sticky, diversified, and margin accretive. Every user who pays $30 per month for Copilot is a compounding annuity, not a one-time infrastructure sale. Nvidia is in a complex position. Its data center revenue is both the most exposed to a CapEx slowdown and the hardest to replace because there is no viable alternative for frontier AI training at scale. Short-term risk, long-term structural winner. The companies in the most dangerous position are those selling AI infrastructure hardware on long sales cycles to customers who are themselves uncertain about AI ROI timelines. That is where the next wave of earnings disappointments will come from. What happens next? Here is your concrete roadmap. The first event to watch is Micron's report today after close. If guidance is strong, it signals that HBM memory demand for AI inference remains robust, and the new market regime is survivable for infrastructure companies with genuine supply constraints. If guidance disappoints, expect a broad AI sector sell-off tomorrow morning. The second event is July 14th, the June CPI print. If inflation remains elevated, the Fed's ability to cut rates is constrained, and high multiple AI stocks face continued multiple compression. This is the single most important macro variable for AI valuations in the next 30 days. The third event is late July earnings season. Microsoft, Alphabet, and Nvidia all report within days of each other. This is the first earnings season where the market will demand explicit AI revenue margin disclosure, not just total revenue growth. Companies that can show AI is margin accretive will be rewarded. Companies that show AI revenue is coming at the cost of margins will be punished hard. The smart positioning right now is not to exit AI entirely. It is to rotate within AI, away from pure growth stories with thin margins and toward companies with demonstrated pricing power, recurring revenue models, and direct monetization of AI at the application layer. The rules changed this week. The investors who adapt first will be the ones who profit most. If this gave you a real edge today, hit subscribe to AI Assets. We publish daily analysis on AI stocks, market structure shifts, and the investment moves that matter before the rest of the market catches up. See you in the next one.